What's going on, guys? This is Lior and welcome back to my channel. Now, what have we been associating multifamily with over the last 12 to 24 months and really even this whole last bull cycle? It's been insane pricing, low cap rates, huge rent growth, right? And with that, a lot of people have been trading multifamily, right? They'll buy and all of a sudden their building is worth a lot more within a short amount of period of time. And a lot of operators are not actually executing and investing into the building, right? Performing the necessary repairs, especially the big stuff. So in this video, what I thought I'll talk about is the consequences of that and how to make sure you don't end up with what I call the Capex hot potato. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes, first of all, if this is your first time on my channel, welcome to the channel. Make sure you smash that subscribe button for me. I put out tons of videos all the time talking all things about multifamily, real estate investing, and syndication. So if that's the kind of content you're looking for, make sure you subscribe to the channel. So let's get right into it. And as I said in the intro, right? Over this whole bull cycle, but it's really been, present over the last 12 to 24 months since COVID. Multifamily has been just trading like hotcakes, right? Again, we've seen insane pricing, super tight cap rates, low interest rate environment for the most part, right? Until recently, insane rent growth in a lot of the different markets around in the U.S., right? And what has happened because of that is, multifamily has just been bouncing, right? People will buy and they can quickly sell for relatively good profits. And I actually just went down to a conference down in Texas a few weeks ago, and I spoke with a couple of operators and they were all telling me the same thing, like, hey, you know what? I bought this building, I was gonna renovate it and bump up the rents, but honestly with the rent growth, I already achieved that rent growth that I projected without spending any money, so I'm just gonna sell it, right? And what's essentially happening is people are gonna continue to trade a decent percentage of these buildings without necessarily investing the dollars to upgrade the property. And believe me, this is not the first time I've heard of this concept, right? One of my business partners recently invested as a limited partner, right, an LP, into a syndication in Florida, and the same exact thing happened. They invested in Florida in early 2021. The rent growth numbers they got were staggering over a course of like 8 to 10 months. They absolutely blew out the rent projections out the water, right? Because, the Florida market has been really hot. Rents have been skyrocketing over there, and they didn't even really need to invest their Capex budget into the building, and now they're selling, right? And this is not a bad thing, right? I mean, those guys, the operators, the limited partners, they're all gonna make fantastic returns on their money. But again, the common theme here is the actual real estate, right? The underlying real estate is potentially getting a little neglected, right? Because if we think about it, at the end of the day, when we buy real estate, we are buying brick and mortar, right? And within that brick and mortar, you have things like electrical, plumbing, all sorts of different mechanicals, right? And over time, these things worsen, right? I mean, it's pretty self-explanatory. These are materials that if you don't treat and repair over time, they're going to worsen. And what I think is the danger here is with these buildings trading so quickly, right? Especially the last couple of years, but really it's been this whole sort of bull run of multifamily over the last 5-7 years, is that some of these buildings are not getting the proper Capex spent on them. So at some point, one buyer is gonna buy a building and he's just gonna get potentially a pretty big deferred maintenance project without really even knowing it, right? Because maybe the electrical and the plumbing and a lot of the mechanicals have just not been maintained, right? People have just been trading these buildings, and someone's gonna get caught with that sort of Capex bubble, if you will. Now, this is actually somewhat similar to what happened earlier in the decade, in 2010s, right, with multifamily. So if you recall, obviously the crash happened in 08, and a lot of people were buying multifamily pennies on the dollar. And, and I spoke with a lot of big operators, and I know this has happened, right, is at that time, they knew that they were essentially just gonna ride the economic cycle to their profits, right? So again, even back then, they bought low, didn't really need to invest that much money to the buildings, right? Because they knew they kind of bought at the bottom of the market. And once the economic cycle kind of wrote itself out, they would sell and realize their profits. So it's a very similar trend, right? So starting really from the Great Recession, where there's a fair amount of danger out there that, you might be buying something that really just has a ton of deferred maintenance behind the walls that you may not know about. So how do you actually protect yourself if you're an operator or even a limited partner looking to invest in deals? How do you protect yourself from, essentially landing on the Capex hot potato, right? Well, I think there's a couple of key things. There's 3 points I'm gonna share with you guys. Point number one is you cannot have the mindset that you are just going to ride out the continued rent growth that a particular market or sub-market has been experiencing and just ride out increased rents without putting a fair amount or significant amount of Capex work in the building. That kind of assumption, I think, is incredibly dangerous and incredibly scary, really, right? Because you're essentially just trying to run on market trends and not actually invest into the asset that you're buying. So point number one is you cannot have that mindset that you're just because the owner before you did this and rode out a market cycle, right, that you're gonna be just the same. So if you're gonna be buying, you have to come in with a mindset that, hey, I'm gonna spend some Capex money to really invest in the asset, and that's what's gonna ultimately cause my rent bumps and rent growth, if that's part of the business plan. Point number two that you need to think about is if you're actually going to go on this business plan of potentially renovating and using that to increase rents or anything like that, is do you have the operations down and the feasibility to execute on these kinds of projects, right? Not everyone can. There's a lot of people that buy turnkey property, and that's fine, but they may not necessarily have the expertise, the operation skills, and the team to really get and execute on a value add project, right? Where you need to go in, invest a certain amount of money into the buildings, into the property, and the mechanicals, right? So make sure that that's kind of your business plan, you have the feasibility and operations down to go and execute on that. And finally, point number three that I would point out is make sure you stay grounded with your underwriting, right? I've talked to some multifamily guys, operators out there, and they've been telling me stuff like, market X has been growing at 8% year over year rent growth last year, so I'm gonna underwrite the same thing and we're gonna call that conservative, right? That's not conservative, right? That's just you are using previous year's data of a bull market run, right? And using that in your own assumptions. Like, that's not really conservative. I think you have to stay super grounded, right, with your underwriting. Do not assume that just because a particular market grew by X% last year that you're gonna get that, especially that's gonna be the main driver of your returns. I think, again, that's very dangerous, very scary. So you must stay grounded with your underwriting. Make sure you truly have conservative and good assumptions about different growth rates, right? And that will help protect your downside in case the market will shift. So hopefully that helps, guys. Again, make sure you really consider this as you are continuing to buy multifamily, especially in this environment, right? I mean, there's obviously a lot of shifts going on right now. It's summer 2022, where the interest rate environment has obviously changed. I think the multifamily market is really about to change pretty significantly over the next 6 to 12 months. So make sure you stay super grounded, and that will help you avoid any major blow-ups in your deals.